Hello and welcome to Exchanges for another week. There's been so much made over the last 3 to 4 years, in fact, let's be honest, for the last 15 years, around housing. And so I thought maybe the best thing to do for this exchange is to actually go the other way and not just look at housing, but look at lending and how lending works and what it's doing and changing to try and impact positively the housing crisis that we currently have. So who better to get in than actually a CEO of a bank? And I've got in the fantastic Greg McKenna, the CEO of Police Bank, a man that needs no introduction. If you've been watching the media for a long, long time, he's an incredible orator, but also gets market mechanisms like no other. So he's absolutely perfect to get on to address this exact point. How do we deal with lending and housing in the current environment? Before we go any further and meet up with Greg, don't forget we are now sponsored here at Exchanges by More, the Lifestyle by Design app designed to get you out there as Australians the best possible option to see the portfolio that you have around your lifestyle, your property investments, your overall investments, and all of it going forward. That's more, moorr.com.au. Check it out today. But now, here's Greg. Greg McKenna, welcome to Exchanges. Thank you so much for joining me. I need to start. There is a big sort of debate going at the moment around how banks work with regards to the fees they charge and the way that we are lending in this country. Lending is now becoming almost like an Australian addiction. Would you agree with that sort of comment?
Yeah, I think it happened sometime in my adulthood when owning a property went from being one of those things on Maslow's hierarchy to an investment.
Yeah.
And everybody feeling like that, owning their own home wasn't enough. They need one or two or three or, in some cases, lots. And so I think that turned, a home into an investment, and a race was on. And, unfortunately, it's caused the kind of issues that we're getting now with housing affordability and those kind of things. So, we've turned our homes into investments, and that's probably not good for our long-term economic forecasts or our society.
Where then does lending sit into it? Because the one thing that obviously has come about is, and I think it's perfect, the answer with regards to turning your property and your home into a house has a different connotation, that
100%.
therefore is an investment.
Mm.
Therefore, I can use leverage, because that's what lending is, to
Yep.
turn my investment further. Because there's now this belief that basically property is almost untouchable, that
Yep.
property is also the investment vehicle that is going to give you the greatest return.
Yeah.
How do we change this demand-driven investment theory away? Because clearly lending is the catch here. That lending and the availability of lending, the way lending sits now in investment structures particularly, has allowed us to get to this point.
Yeah, it's an interesting question. So serviceability realistically is what drives property prices.
Mhm.
So your ability to borrow a certain amount depends on yourself and your partner's, if you're in a relationship, yourself and your partner's ability to service the loan. So that the size of the loan then, depending on how much you've saved, has an impact on the type of property and the size in terms of cost that you can afford. So lending is central, always has been. But leverage, as you articulate, is the thing that a lot of folks now take for granted as if they could never lose. And so in the past, in the old days, when you had to stump up 20% deposit, and then the bank would lend you the other 80%, that was a lot lower leverage than stumping up 5%, having the other 15% guaranteed by the government, and then repaying the bank loan for the 80% that the bank probably lends you. So you look at leverage, and it's serviceability and leverage that have, in many ways, driven property prices up. And part of that serviceability is your ability to offset your tax against your interest and those sort of things. So I think it's a complex web. Alan Kohler wrote 87 pages, I think, in the quarterly and couldn't really solve it. So I read that, and I live in Newcastle, and one of the answers was build a high-speed train to Newcastle. Would be great for me. I could get to Sydney in an hour, but it would just export Sydney's property price problems up into the Hunter. So leverage and lending is a cornerstone, but it always has been. So it's not just the ability to get the loan that makes the difference. It's the approach to borrowing. It's the ability to offset tax. Some people can, some people can't. It's how you fund your deposit, those kind of things. And I think it's got to the point now where it's without property prices doing nothing for an extended period, it's hard to put that genie back in the bottle.
Wow, there's so many things in what you've just said. I'm going to have to really go. So first and foremost, the other part that I then need to put into the leverage equation is collateral, because you
Yeah.
spoke about before the serviceability, but then those that have turned property into an investment and are using
Yep.
the existing properties as collateral.
Yep.
Is this also part of the question and answer around fixing it? Is that reducing the amount of collateral you can use for existing properties, or turning around and changing that, new properties have to be serviced with income rather than serviced with collateral from existing properties? Is that the other part of the next part of the equation?
So now we're really talking about changes to negative gearing,
Yeah.
realistically.
Yep.
And whether you favour a limit of one, or you've got to discount the rent because maybe the rent's not going to be there, or you can only use a certain amount of the collateral. It's really a whole of housing question
Yeah.
that needs to be looked at. We also need more supply. We know that, right? So, the supply argument, I think, would, Peter Chulip's written some great stuff about supply. And if we build more houses, then that's going to have probably an outsized impact than if we just say you've got to discount the rent or you can't use the collateral. Because I think ultimately it's still a supply and demand argument. And as both you and I know,
Yes,
from
it
our
is.
background in markets, it's really just about supply and demand. There's too many people bidding for a fixed number of houses at a fixed point in time, and we can't satisfy that demand. So it's only when people get worried about the economy, when interest rates go higher, that people step a little bit back from that demand side, and then property prices flatline or go down a bit. But then the demand comes back, and the supply is still fixed. So then you get these step changes in property prices that just seem to come after a pause. How do we address it? Supply. We've got to build more houses. New South Wales government and what they're trying to do, I think, is the right approach. What the federal government's trying to do with more houses is the right approach, building them. We've just got to be able to put them in the places where people want to live. And I think that's part of the issue too.
Absolutely. But again, the other part you helped on in your previous question was, at the moment, governments are falling over themselves to give you the demand side and pretty much guarantee your 20% deposit that is ramping up. As you said, this fixed point in time, they know that the demand is there, the demand is a vote, and the vote needs to be satisfied. So the next part of then is, it's not necessarily just the credit, it's not necessarily just the way that we're assessing serviceability, it's the fact that governments now are falling over themselves to put risk in the market themselves. How do we get around what both sides of politics are currently proposing?
Some vision, I guess, some longer term thinking. We know it's a hard nut to crack. We know that, I'm a mid-50s father of 20-something kids. They're already struggling to see how they can ever afford a property. And if we keep doing this demand side stuff, it just gets further and further away, unless there's an inheritance or a gift or something like that in many ways. So I genuinely think that the government's got to step back and take a whole of society and a whole of economy view and really think about what can be done. There's lots of things being done to help with housing affordability. We've got the super funds doing rent to buy. Some of them have started to move to rent to buy to own, which I think is where we need to go, because
Just take us through that for those that don't know how that will work.
yeah, sure. So rent to buy is what it sounds like. So super funds will build a block of apartments for in this example, and folks can move in and they can rent there on long-term rents. So unlike what seems to happen with a lot of people, you're 12 months, 2 years, 12 months, that kind of stuff, because the
Or
houses,
month to month, once your contract expires. Yep.
yeah, that's right, perpetually turn over and that sort of stuff. So the super funds and the companies they're working for are working with, I should say, the builders and the developers, they will give you security of tenure for a longer period, right? So you can, you know, uh, have your kids. Having kids in an apartment is a different question. But that's the build to rent, right? So homeowner doesn't buy a home, they're just renting. At some point, most Australians, it's part of our psyche. So at the moment,
Yes, it is.
we want to own something. So there's a few of these developments that are moving towards, and a few of the super funds are thinking about this whole of life cycle because there's a pathway. And so they're looking at build to rent and then own, in the same way that when I was a kid growing up in Guildford, which is in Western Sydney, the other side of the street was housing commissions. My grandparents had a housing commission. At one point, New South Wales government gave everybody an opportunity to own those homes. So my grandma and my grandpa owned their home in Auburn. The people across the road own their home in Guildford. And so that's what the build to rent to own is. There are plenty of other, there's the affordable housing that's going into a lot of developments now. There's the key worker housing. New South Wales has got an inquiry, or has undertaken an inquiry into key worker housing. So we're talking about the kind of people, the members that we serve at Police Bank. We're talking about police, we're talking about nurses, we're talking about fireys, teachers, basically anybody that was essential in COVID are key workers. And so we're looking to solve that problem too. We're working with an organisation called Hope Housing on a shared equity scheme for key workers, essential workers, and that way they help with the equity, and so the fiery or the police officer or the nurse has a much lower mortgage and can live closer to work, so that they don't have to travel so far. There's lots of different community housing, so it's a big question, and I think that there are.
But what you're saying is that that's being addressed, because I think at the moment there's this belief that it's not being addressed by particularly people in your world, right? Particularly
It is being
banking,
addressed. Yeah.
that it is being addressed. And this is, I think, where the discussion is that, somebody like Police Bank is actually there providing real solutions, that is actually addressing supply side, that is actually addressing affordability, that is removing necessary but burdenish market forces around renting. So that's also part of the bigger, broader question for you is, we want government, and what we're suggesting is government needs to step back. Players in the market, banking particularly, steps into the fold. What else can be done?
So I think there's a role for government to play. I think Housing Australia, in many ways, with the building that they're helping facilitate, is a really important part of it. If we say, what's the absolute fix for the housing affordability issue in Australia? It's supply, right? It's building more apartments, more houses on the land that we've got in the places where people want to live. Now that's a hard
question.
nut. Yes, yeah. And it's a difficult thing for people to swallow, because
More NIMBY comes in, right? So
yeah,
not in my backyard.
Yeah, but not even just that. It impacts on their investment in their house.
Yes,
Suddenly their house is a home again. And I think that what folks have forgotten is that, whether it was my grandparents who bought their house in Auburn or the folks across the road in Guildford, my mum and dad in Guildford, those property prices still appreciate it. They just didn't appreciate at the same pace that they have in the last 25 years. So you still got a decent return on your investment if you want to think of your house at that. You still had forced saving. You still had a property into retirement. This is the thing that troubles me about where housing affordability is. We're going to have a generation that goes into retirement without the security of tenure of a home.
Yeah.
And so they might have yeah, that's right. They've still got a mortgage, or they've never bought one, and suddenly all that super money that's supposed to get them through has now either got to pay off the mortgage, or they've got to buy something to give them some security. So we've got to start now, and I think government has got a role to play, but it'd be nice if, I think, once this election's out of the way, everybody could take a breath, step back a little, and take a whole of economy approach, and then we can add into the areas that private sector is already trying to do, and we can add into the areas where we can see the biggest bang for the buck. And again, I think the New South Wales government is probably, and I know they have shared equity schemes in other states where the state governments are trying to do things, but the New South Wales government is seriously trying to unlock supply. And I think that is, I know I've said it about 50 times, But that's
That's the
probably
future.
the
But
key for me. It's got to be more supply.
yeah, so again, the catch though is demand side movement is instant, supply side is years.
Yeah,
And so, as you said, if you look at the fixed point in times, which is what we do as human beings, and that's the behavior behind it, is that we are looking right now, there isn't a way out. I need to get in now. In 5 years' time, I can't wait for the build to rent schemes or the
yeah,
build to rent to buy schemes or, the overall unlocking of land that takes a minimum of 2 years to get
yep,
done.
yep,
All of that's there. I want to go back to banking specifically because the other thing that we know that's happened, particularly over the last 3 years, with the changes in cost of living and the increases in inflation, leading to increases in interest rates globally, is around the way, particularly lending and mortgages in Australia are done. We are a very high variable mortgage
yes,
market.
yeah,
You talked also before about, different products for housing supply, etc., to come in. Is the lending product itself needs to be addressed? I mean, there's been talk with Larry Fink was here 6 to 8 weeks ago talking about you know American style 30-year length fixed rate mortgages. Do we need to start considering that kind of product, particularly for first homeowners, particularly for the lower end of the market that need a simpler, easier products to get into the market on?
yeah. So I think we need to think deeply about this because if you've ever spoken to somebody who's got a fixed and then something happens in their life and they have to sell, and most fixed in Australia is maximum 5 years,
Yeah.
and their mortgage is underwater, and suddenly they've got to pay a bank 20 or 30 or $40,000, which makes whole on the interest that they would have paid. Imagine that on a 30-year and the duration there. So we need to think about deeply how we're going to manage that. Also in Australia, it's be a lot harder to hedge. So a bank takes a. I won't go too deep into banking, right? But
No, no, please
there's,
do. This is
there's
what I wanted you to go into because this, I think, is
okay.
also missed about how banking works. There is this idea. I always argue it quite simply in the fact that you've got a creditor to a bank puts a margin, then puts that margin into the market as the lender. That's
Yes.
what banking is.
Yep.
But there's a lot more mechanics in it than just that simplicity.
There are. So if I lend to a an Australian homeowner at a variable rate right now, um, my risk is against the cash rate and the margin that's against the cash rate. So the cash rate goes up or down, the margin roughly floats, give or take competition. If I lend on a fixed rate loan, I have a completely different interest rate risk. And the longer that interest rate risk goes, the the longer the term of whether it's a 5 year or a 30 year, the more interest rate risk I take as a banker, as a lender. And so then I've got to find a way to mitigate that risk to stay within acceptable risk limits that APRA and any board of any bank would have. And so that means I've got to change the characteristics of that interest rate, most likely back towards a floating rate, which is where we are now. That's pretty straightforward out to 5 years. It's getting more straightforward longer, but out to 30 years, there's not really a way that your average Australian retail bank could manage that
Does
interest rate
super
risk.
come into that? Do you go and tap the supermarkets and say, here is a long dated fixed bond or coupon or paper that
Yeah,
has a set?
that's why we'd have to think deeply about it. We'd have to gauge their interest. Because of course, with all the rules around, the performance of super and that kind of stuff, can a super fund actually make a commitment to stay in for 30 years? Well, the answer is probably not, because we all know I was a fund manager back in the 90s and ran a fixed interest fund. It didn't change. It hasn't changed that much. The market moves, and you've got to have liquidity, and you move your interest rate duration and that sort of thing. So we'd need to really look at whether or not super is happy to allocate to 30-year Australian residential mortgages. I can't answer that, but I'm sure that if in finance anything's doable, if you've just got the will to make the decision and to invest, because you can always use the markets to change the structure of your interest rate exposure or your liquidity exposure or any of your other exposures. It's just about knowing what to do. But it would be a groundbreaking move, and it'd probably need a big bank and a big super fund to really kick off the 30-year. But don't forget, there's a lot of interest rate risk that the bank's hedging that's then transferred to the homeowner.
Yep.
And if they have a life event change, they're going to have to get out of that loan, and sometimes it's going to cost them a fortune.
Yep. And I think that's why there's sort of this shiny red herring almost in terms of this offering, that it's this idea that it's a better opportunity and what have you. Yeah, during COVID, maybe when you got interest rates of 1.5 to 1.9 for 30 years, which they do in the States, but
so
it's
I think, if I may, and I don't mean to cut you off, but I think it's an important point. The volatility always pops out somewhere.
Yeah.
And so a really good example of this is when New Zealand, a long time ago, back in the 90s, I think it was, they had a monetary conditions index, all right? And they were trying to stabilize their currency. And what ended up happening? Their interest rates went all over the place. If we changed the shape of how Australians do mortgages, that volatility pops out somewhere else. And it'll pop out on either a bank balance sheet or a personal balance sheet for mum and dad if they've got to sell, those kind of things. So I think the key message I'm trying to make, slightly ham-fisted at the moment, is that there's no free lunch.
Yes.
Right? That you've either got the volatility of the Reserve Bank moving rates up and down, or you're going to have the volatility of a life event, meaning that you want to get out of a longer-term mortgage at some point when longer-term rates have moved. And so that's going to impact on how much you've got to pay the bank, or the value of what your mortgage becomes if you add it onto your mortgage if you move.
The other thing you talked about in the net interest margin sort of competition, which is that margin that banks put on between their borrowing and their lending, is competition.
Yep.
There is evidence that competition is growing, but again, the big four continue to be the behemoths, gorillas that they are. How do we continue to move that way? I mean, I know we've gone from about 100 institutions in 10 years ago to about 143, 145 as we speak. There is signs that more and more institutions want to get a financial credit license in this country. But is competition working, or is there still basically the problem we've had for a while, which is that 4 or realistically 6 major players control almost 85 to 90% of the industry?
I think with 26 or 27 million people, we remain a natural oligopoly market. That's just the nature. And I think that if you look at the impact on the big guys from the Royal Commission or other setbacks they have, Australians love their big banks, right? We'd like them to love mutuals a bit more, and they do. We've grown our market share as a sector, so the Customer-Owned Banking Association, mutual banks, mutual building societies, places like Police Bank, we've continued to grow our market share, but people like the big brands. That's the reality of it. Competition, though, is fierce. There are some pockets of Australian retail banking that are just phenomenally fierce. Southeast Queensland, for example, is just a phenomenally fierce mortgage market. The rest of the country is just fierce, but that's phenomenally fierce. And so what you're seeing, one of the big majors dropped their acquisition rate 1%. Now that rate is still above what most mutuals would offer at, but it's now a really hot rate from a major as an acquisition rate, and it's public. So none of the ducks and drakes that they used to, that sounds wrong when I say it that way, but standard variable rates used to be, and then people get a discount and all that kind of stuff. So it's now just, here's the rate. And I think that signals to me the next wave of competition. If anything, Macquarie's shown that competition does work. They've shown that technology with good pricing and a good customer proposition works, and they've grown their mortgage book in their retail banking arm phenomenally well. So I think that competition is still fierce. I think margins will continue to contract, and that where the margins are at the moment or headed is probably getting to the point where, and I think you've seen some of the majors talk about this, their returns on their cost of capital start to marginalize.
Yeah, they do. And we're starting to see the fallouts in that, right? We're starting to see movement in around employment, movement around in external costs.
Yeah. Yeah.
The thing that you highlighted, I'm glad you pointed out Macquarie, because I think that's the one to really highlight here.
Mhm.
It has and knows how to be a disruptor. It's what it's always prided itself on, as being an investment bank. Now in the retail space, it's
Yep.
bringing that same mantra. But you
Yeah.
talked about digital, and you
Yep.
talked about the rise of what that is bringing.
Yep.
Where does AI now sit in the banking world space? Because, as you said, you are talking about the rise of competition, the rise and rise of no longer sitting behind, here's the standard variable rate, but if you come to us, we'll offer you a discount rate of 90
Yep.
bips or 100 bips or
Yep.
120 bips or blah, blah,
Yep.
blah. Is AI going to push that even further, where it can very quickly sharpen the pencil, get the deal done much, much easier than
Yeah.
having to go through that space? Is that the next thing and the next revolution that's going to hit banking?
Yeah. AI is a massive unlock. Used properly and in a way that you can understand the black box, which is critical. You don't want your members or your customers being knocked out for some reason that the algorithms got wrong. So in our case, for example, we want to try and say yes to everybody who's in policing or other essential services, those kind of things. So AI is the unlock. It empowers our workforce. It'll help us. We may be able to, in the future, um, if you're a main financial institution, you'll be able to see a customer's ins and outs through their accounts. You'll be able to see that they've got an exceptional credit. You'll be able to see that they can probably afford to pay down their home loan sooner, which is ultimately what we all want, right? We want to, from our point of view, from whether it's Police Bank or other mutual banks, we want to help people pay off their home loans as soon as possible. And so we'll be able to use AI, I would have thought, to unlock helping them. It'll unlock credit approvals. It'll speed up credit approvals. It'll unlock back office processes and speed those up. And so it's right in this nascent. It kind of feels like late 90s NASDAQ internet, I should say. It was clear that it was going to change our lives, but we weren't exactly sure what to use it, and we weren't exactly sure who the winners were going to be. And I kind of feel like AI is in that. We know
Yeah, I'd agree.
NVIDIA and those kind of guys have done fabulously well, but the use case, the companies that help us build the use case and then roll it out and operationalize it, and then do it at scale, they're the ones that are really going to do a big job. And so I think Australian banking is due for an unlock, and I think ultimately what that'll do is it makes us more productive, which is a euphemism for less people, which means you can probably afford to let that margin come in an extra 5 points or an extra 10 points, which across a 30-year mortgage is a lot of money.
I'd argue it's not just the people, it's actually the infrastructure. I mean, if you look at the amount of cost that particularly the bigger banks have on servicing infrastructure, is
Yeah.
incredible. I mean, if you
Yeah.
don't need the space that they currently occupy across the country, then that would also unlock it. So the final part of this whole discussion around credit, lending, Australian banking, etc., is regulation. I mean, that's the other part of this. You alluded to the Banking Royal Commission. We know ASIC and APRA do what they do. Sometimes it's hand in glove, sometimes it's not.
Yeah.
Are we over regulating, under regulating? Where are we sitting at the moment? Because it is there, and it's almost at the moment, if you listen to the retail handback side from the customer, they feel that regulation now is such a burden because the banks have passed it through. No, KYC, AML, all this kind of stuff. What's your view at the moment about how regulation has moved and whether or not we've gone too far, or if we are still allowing behaviors that shouldn't be there to get through the cracks?
So I think that if we think about the kind of society we want to live in, and the kind of economy we want to have, then a lot of the regulation just needs to be there. Like you say, your AML, your customer, all those kind of things. You want to know that it's a real customer. You want to know that it's not a mule. You want to know that when you do you design a product, that you've got a target market determination that makes sure that if this product is meant for Evan Lucas, then it goes to Evan Lucas and it doesn't go to Greg McKenna, if that makes any sense.
Yes, it does.
So I think that a lot of the regulation is a result of um, the regulators asking banking to do better, and then saying, well, okay, if you can't do better, then we're going to force you to do better. And so to that extent, We can't really complain as an industry because, as the Royal Commission showed, and behaviours have shown over years, we needed a bit of a nudge. So some's about society, some's about treating your customers well, treating them right. Then you get to things like 234, which is an APRA standard about cybersecurity. Absolute must. It's just good business practice. You get to a new standard that's coming in, which is 230, which is about operational resilience. Just good business practice. But gee whiz, it's a lot of work. It's a real lot of work that everybody has to do in the banking and the super and the insurance sector. Does it increase our costs? Absolutely, it increases our costs. But what the regulators are trying to do from a banking, superannuation, insurance is make sure that Australian banks are, and insurance and super, are really strong. So I have my view is less jaundiced than I think some of my peers in terms of regulation, because some of it I think is just good business practice. Some of it I think we've brought on ourselves. And it's all, to my mind, focused on looking after the customer, which in our case is a member, and that's what it's supposed to be all about. So, it does make us more expensive, and it does, running a business, I should say, does make it more expensive. But in reality, there's not, there's the odd bit and piece of a APRA standard, or maybe what, ASIC says, or, the reporting you have to do and the regularity and all that. There's bits and pieces that we can quibble over. But in general, I think the regulators have got it right in the settings that that they've got. And I'm really pleased that they're working together now, because previously there was, there'd be a new ASIC and a new APRA and a new other regulator, and they'd all be taking off at the same time, making it really difficult to manage. But they're working better together now. So I think the regulations that we've got are pretty fair. One of the ones that obviously comes to mind, given the discussion we're talking about, is the 3% buffer.
Yeah.
And I think that if I turn the pyramid upside down on what most people think about the 3% buffer, you'd say right now it's keeping people out of the market. When rates are at 0.1% and people could borrow at 1.84, that assessment was 3% above that. That's one of the reasons why the mortgage cliff didn't happen in the way that a lot of people imagined it. Every single bank in Australia that lent to somebody had a 3% buffer on that loan that they borrowed at 1% or 2%, 1.5% or 2.5%.
Which is where we are now, right? Which is, it's actually higher than that in some respects in terms of where loans are.
Yes. So that's why we didn't have the mortgage cliff. So I know that it is difficult now for people to refinance, and they say, oh, well, I'm in at this rate, but I can't move across to a lower rate, because if you add the 3%, then technically I don't service. Practically, I don't service, I should say. That is a bit of an issue. But in general, I would say, look at the performance when the RBA jacked rates as hard and as fast as they did, and the impact that had on actual people losing their homes or going into bankruptcy, and you'll see that the buffer on balance is something we should have.
Yeah, and I'd agree. And I think that's why it needs to still be there. I mean, again, what I've always argued, I know I'm not going to put you in this position by saying this, but because it's harsh, but in the end, banks are also your counterparty. I mean, they make money out of you. So this is always the catch-22, and why, as you said, there has been some, not many, but enough bad eggs in the industry that because they're incentivized to actually go against the people that they're there to support. Now, why mutual banks like yourself are so important is because you are aligned in your mantra as a member-based institution rather than a sort of a private institution. But that's always the catch, right? And that's why, again, regulation's just guardrails. I mean, it's why it's there. And that's exactly what it needs to be part of.
But don't forget, Evan, if I may.
No, go for it.
The other side of the balance sheet is also important, right?
Yes.
So the deposit side. So we are the intermediary. So you said we're the counterparty, and yes, we are the counterparty, but we're the intermediary. So we mostly borrow from members, and we lend to members, right? So we have to take serious our obligation to the members to pay them back their money, because we've borrowed it from them. And so things like the buffer and things like the credit policies and all that kind of stuff, they play a really big role in setting up your appetite for what you'll lend, who you'll lend, what LVRs you'll lend, what rates you can afford to, and all those kind of stuff. So those both sides of the balance sheet need to be taken into account as well.
Yeah, I'd agree. I'm amazed we've talked about so much. I need to come to the question that I ask all of my guests the very last question for all of these exchange interviews is, Greg McKenna, if you're in charge for just one day, what would you do?
I'd build more houses. That's honestly what I do. I believe that the society we live in here in Australia is so important, and it sits on people's ability to own their own home. It gives them confidence. It gives them comfort. It gives them somewhere to raise their children. And I would work really hard to build more houses, to address affordability, so that we can know that, my kids and my grandkids can have the similar sort of experience that you and I had and that other people have had. And I think that it would be really, really important for government to take a step back and just look at that, because it's the most important question for our society, is getting people into housing and getting them to be able to lock in for 5 or 10 or 20 or 50 years.
I'd have to agree. I think that's a beautiful answer to that question. Greg McKenna, thank you so much for joining Exchanges today.
Thanks, Evan. It's been a pleasure.
Told you that was a different episode, and what a thought process Greg has around lending, what it's doing, particularly his view that Australians now have of going from a home to a house. I think that term particularly really resonates with me, that we've definitely moved that way. We've moved away from understanding that a home is a shelter to a home is a house that's an investment. I loved also his insights into the whole lending space, because it is one area that really does amp up your investment opportunities, does come with risk, but it's also put risk into the system. It's also made changing the system all that much harder. So thanks to Greg for all of that insight. It was absolutely fantastic. Once again, to you out there, thank you so much for listening or watching or wherever you're getting your Exchanges podcast. I really do appreciate you taking the time to watch this. As always, don't forget, please, if you've got a question, idea, exchanges@evanlucas.com.au, get that in there. And also, please subscribe wherever you're listening or watching this to. The more and more subscribers I can get, the more and more guests I can get on. But until next week, thank you again for joining Exchanges, and I'll see you then.